All right, today we're going to deal with chapters 15 and 16. Chapter 15 deals with unemployment, talk about what creates it, how it happens, how you solve it. And then the following chapter, we're going to go into things about money and the Federal Reserve. Again, this is your lecture before the vacation for Thanksgiving. Remember, there is no class on Tuesday. You have Tuesday off. But on Tuesday a week, we will have a quiz on these two chapters. So after Thanksgiving holiday, a quiz on these two chapters, and you'll have plenty of time to study. So I assume the grades will be awesome. Okay, so chapter 15 deals with unemployment, which is a critical thing in any economy. Nobody wants their labor force to be unemployed and out of a job, and rightfully so. Number one, it creates uncertainty and nervousness and possibly anarchy in the employment force, and also it leads to a tremendous reduction in taxable income and therefore tax receipts to the federal government. All right, so without any further ado, let's talk about unemployment. Okay, unemployment is basically the result of business cycles. And we've talked about business cycles before, but let's go through it again and refresh your memory. In a business cycle, we have peak, and again, the peak is a temporary maximum. It means the economy is running at full force, doing well. Everybody's happy, people are working, unemployment is down below 5% or less, which is what economists call normal unemployment. And we'll talk about how they get to that number and what normal unemployment consists of. So we have a peak that's a temporary maximum, and then we have a recession. Now, a recession means that GDP is declining, we have employment declining, and we have income declining. So remember that. On the road to depression or eventually to recession, we have declining GDP, employment, and income. Now, declining employment means we're experiencing a higher level of unemployment than we want, above 5%. Declining GDP, most economists today figure that if GDP is declining for 3 quarters in a row, then that represents or constitutes a recession. Trough, this is the bottom. It's called a recession or depression. In 1929, the stock market crashed in October 1929, and we started with the Great Depression. Unemployment shot up to 20% of the labor force. And then in 2008, we had the beginning of the Great Recession, and unemployment shot up to over 10%. Not quite as bad as the Great Depression, but serious enough to cause the government to take some significant actions, both at the Federal Reserve and at the federal government level. And then lastly, after we go through a recession or depression, we have a period of expansion and recovery. And that's the hallmark of expansion and recovery is a rising GDP. That means the percentage of GDP is increasing from quarter to quarter, year to year, increasing income and increasing employment, which means that the unemployment percentage is declining over time, right? That's the 5% criteria that we use. And we're headed back, we would be in an expansion recovery mode where we would be headed back to what economists call really a normal unemployment level, which is about 5%. Okay, let's look at this chart again. You've seen it before, but here we have business cycles in the stock market. The stock market may be a pretty good indicator of what's going to happen or what is happening in the business cycle. For instance, when we experience a bear market, it means we may be heading to a recession and a trough. A bull market indicates we've got expansion and recovery, and we may be headed for a peak. So analysts, both in the government and also on Wall Street, look at this stuff all the time. They spend their entire lives paying attention to this stuff. So business cycle causes. How come we have business cycles? Well, just as an overall philosophy, you have to remember that most things don't last forever. When we have good times, they may lead to some bad times. When we have bad times, they may recover and we'll get good times. Everybody deals with cycles. We have business cycles, we have weather cycles, we have personal emotional cycles where one morning we get up and we're ready to come to economics class, and next morning we get up and we care less about going to economics class because Professor Dubell is just going to torture us with a lot of stuff we really don't care about. I'm kidding. Okay, so causes are possibly irregular innovation. Now, innovation, there's no way to time it as to when it hits the economy, and it may cause disruptions in the economy. For instance, in the field of automation, we've replaced in a lot of modes, in a lot of factories, we've replaced workers with robots. And we've done a lot with forecasting, et cetera, with the use of computers. So these innovations aren't necessarily timed in such a way as to hit the economy to make it grow in a pattern that's consistent with what we expect to happen. The problem is innovation hits at any different time, whenever it raises its head. Productivity changes in output. Okay, we go along and we're doing good, we're improving. Remember, increasing productivity leads to increasing gross domestic product, which means more units of labor are producing more goods, and that's positive productivity. The other side of that is negative productivity, where our productivity is not growing as much as it should, and therefore it has an impact on the economy, and the growth of GDP slows down. Then there's monetary policy. This is the policy that falls into the realm of the Federal Reserve. The Federal Reserve is the money manager of the economy in this country. Okay? In other countries, it's a central bank. In London, for instance, it's the Bank of England, and the government policy type person is the Chancellor of the Exchequer. In China, for instance, it's the People's Bank of China, the largest. And their policy is a lot determined by the Central Committee of the Communist Party. So interest rates play a significant portion. If the economy is improving and we're running a risk that maybe we're going to have inflation, the monetary policy people would raise interest rates to cut down on the amount of borrowing and therefore reduce the amount of money in circulation. If the opposite is true, if we've got unemployment, the monetary people would reduce the interest rate to encourage people to borrow more and spend more money and expand the economy and get people back to work. Political events also cause problems for the economy and business cycles. Wars, World War II, World War I, Vietnam, etc., all had an impact on the economy. 9/11 had a huge impact. It smacked right into Wall Street. A lot of companies were close to obliterated. The bond traders at Cantor Fitzgerald, their company was almost eliminated. The college that I went to, 5 graduates died because they were in the floor just above where the plane hit, and there was no way they could get out. And as a result of that 9/11, for instance, the Federal Reserve dropped the interest rate dramatically right away to encourage people to say that, hey, everything's all right, we've got it under control, we're going to make it easy for you to borrow money and to bring the economy back in line with the way it was before the 9/11 disaster. Financial instabilities, bubbles. This is nasty. We had a tech bubble in 2001. I got clobbered in that one. In the Great Recession, we had a housing bubble burst. I got clobbered in that one. You'd think I'd learned my lesson, but I didn't. So be careful of bubbles as you're going through your life. If it looks too good to be true, it probably isn't true. So be extremely careful, extremely diligent, and extremely cautious. Know when to take risk like cards, know when to hold them and know when to fold them. Study the situation and make sure you know what's going on. Okay, the macroeconomy, unemployment, inflation, and deflation that are known as the business cycle. Unemployment. What do we mean by unemployment? Well, number one, it's the number of workers in the labor force without jobs. Okay? We measure the labor force by anybody above, I believe it's 16 years old, and anybody below retirement age. That is the labor force, for instance, in the United States. So the number of workers without a job, for instance, if your labor force is 100,000 people and you have 1,000 people out of jobs, you have an unemployment rate of 1%, etc. So that's how you calculate it. You divide the number of workers employed, or not employed, excuse me, the number of workers in the labor force divided into the number of people unemployed. That gives you the ratio or the rate of unemployment. And as I said, we like to see that around 5%. That's what we call normal unemployment. So how do we measure that rate? As I said, unemployment by the size of the labor force. Now, there are three labor force groups in general. One group is those that are unemployed. The other group is those that are employed. And the other group is those that are not in the labor force. One of the problems we've had in this current recession is there are a lot of people who gave up looking for jobs and therefore took themselves out of the labor force. Duration of unemployment. This is critical. We have unemployment insurance if you lose your job, and it generally lasts about 14 weeks. If you're out of a job for more than 14 weeks, it becomes a bit of a problem. For instance, long-term unemployment can lead to a loss of self-confidence, particularly if you're married, have a family, and you're the sole provider for that family. The longer you're out of work, the more self-confidence tends to erode. And therefore, long-term unemployment tends to be debilitating to the people who are unemployed for a long, long time. Next, the longer it lasts, the harder it is to find employment. Now, you're looking for a job and you get a job interview and you're sitting across from the human resources person. And you've been out of work for 6 months, 9 months, maybe a year. Sitting across from you is that HR person who has in the back of his or her head, why has this person been out of work for so long? Is there something wrong with this person? Should we not hire this person? You won't hear your HR people say this, but it is in the back of their head. So there may be a case where if they can find someone, if you've been out of work for 9 months and someone else comes along with the same qualifications, they've only been out of work for 6 months, you might lose out to the person who's only been out of work for 6 months. It's a very, very tricky thing. Okay, and next, workers become discouraged. So they drop out of labor force. Well, dropping out of the labor force means they cease to look for employment. And the end result of that is because they need money to support their families, they will accept part-time work or become underemployed. When we say someone is underemployed, we mean that they've got a job below their level of either experience, training, and or education. Okay, it would be a college professor slopping hamburgers in a McDonald's. Okay, that's the type of thing we're talking about. Okay, and I don't intend to go to work at McDonald's. All right, unemployment. Let's look at this in its pieces. There are four major pieces to unemployment. First is frictional. And frictional is really what we look at in terms of what we call normal unemployment. And this is the number of workers between jobs. And we anticipate that this would be about 5% of the labor force. Some people also refer to this as a natural rate of unemployment, but for us, we'll stay with the idea that it's frictional unemployment. So these are people who have a job, but they're transferring from one job to another, maybe from one state to another, maybe out of the country, but they're not unemployed. They haven't filed for unemployment checks or insurance payments. So they are still part of the workforce, just not currently working in the labor force. Okay. This is typical of people, you get a new job, you're going to transfer to Colorado, and you decide to take some time off between the jobs and take the family on a vacation. This happens all the time. And this is frictional unemployment. It's normal, and we expect it to be there all the time. Next is structural. This is the worst kind. This is the kind that occurs because of changes in demand. In other words, the demand gets less or gets reduced. Foreign competition causes jobs to move overseas, which we've seen to a large degree in the US in the last 10 to 15 years. Geographical changes, business conditions, all of those things lead to what's called structural unemployment. And structural unemployment is the worst kind. And believe me, companies don't want to lay off people in their workforce because they've invested in time in training them and developing those people along the lines of understanding the business that they're in. And that's part of your education process. I can tell you all the stuff that you need to know, but until you actually get in the workforce and work in a job, you will learn a lot more than I can teach you. Okay, the other piece of this is structural. It means a lot of people just give up. You leave the workforce because they can't find a job, so they just give up. Cyclical. This is caused by swings in the business cycle. It just means that, okay, we've got a trough, we're going to lay people off for a little while, things are going to come back, and we're going to be okay. That's what they call cyclical. So cyclical unemployment is the result of swings in the business cycle. Seasonal. Typical summer work or winter work. You guys are part of the seasonal workforce yourselves. Those of you who work, let's say, at Lowe's or someplace like that, helping with Christmas trees at Christmas time to make some extra money. So what it is it's seasonal work. You're not typically part of the labor force for the 12 months of the year. You're only part of the labor force at certain times of the year, mainly the holidays, the summer, etc. And by the way, when the government reports employment statistics, they adjust for these cyclical and seasonal changes, particularly the seasonal changes. So how does the government get involved in this and solving the unemployment problem? All right, number one, out of the recession came something called, out of the depression really, came something called unemployment insurance. And what the government is attempting to do here is to reduce the effects of unemployment on people's income. And what you can do is you can go to your human services or social services office. You've been laid off. You can apply for unemployment compensation, unemployment benefits. And I think they last 13 or 14 weeks. I'm not sure which it is. During the Great Recession, the government extended this unemployment insurance several times because people were out of work for so much longer and they needed to help them. Okay, now the problem that we get into here is, do these unemployment benefits create a situation where people would prefer to be unemployed, to take advantage of the system? In other words, gaming the system. It's one of the concerns that people have. So there's a lot of checks and balances on it, but it's almost impossible for the government to police this. Okay. So the key here is the government wants to make sure that your income doesn't get hurt in the short run because you're unemployed, you've been laid off, particularly because of changes in the business cycle. And again, though, you have to file for the benefits with your social services division in your local area. Okay, benefits. Typically 50% of your former wages for up to 26 weeks. Well, there's also a limit on what we mean by 50% of your former wages. I think there's a limit of like $350 a week or something like that. I'm not that up on this that much. And again, as I mentioned before, does a program like this create unemployment? Do people deliberately use it to game the system? For instance, if you get a job and you pretend you don't have a job and you continue to collect your unemployment checks. I don't think anybody really knows how much this happens. It's a possibility. It's out there. Someday they'll do some studies and find out if they haven't already. Okay, declining employment. What do we mean by that? Well, when employment's declining, in addition to the government insurance program, we have things like food stamps. And this helps you, you're out of a job, or you're needy, or you have no income, or whatever the case may be, or you're handicapped, can't get a job. This is a program that gives people food stamps that they can turn into grocery stores and buy needed food. Okay. It's called the food stamp program. Um, it's probably at its peak now as a result of the Great Recession. Congress is looking into things, and the states are looking into things that reduce the cost of this program. But it's there for the needy. It's there to help them cover the essentials of life that they need for their family, mainly food. My wife was in a volunteer program in the California desert, and she went around with the men while they did their shopping at Walmart or Target, whatever the case may be, Target, and made sure that they bought stuff that was good for the family, the right kind of clothes for the kids, the right kind of food, baby food, etc., and that the food stamps weren't spent on things like alcohol or sold to another party or tobacco, etc. Social Security. These are disability payments to a worker who's injured on a job. So you get hurt on your job, you can no longer work. The government will pay you disability payments while you're injured and not able to find a job. And these payments come out of the Social Security program. We talked about when I gave you the presentation on Social Security. Disability payments are payments to injured workers who've been injured on the job. Now, the problem is this system is kind of easy to game too. I think we talked about it. Because what happens is you get better, get a job, and you don't report back to the Disability Payment and Social Security Administration that you are back to work, and you continue to get checks through this feature. I think in the terms that's called double dipping. Pell Grants. Now, this is an interesting one. I'm not quite sure. The author talks about it, but I'm not quite sure that this is appropriate. I don't know. Pell Grants aren't that significant part of your income. Does a Pell Grant, for instance, I guess the question he asks is, does a Pell Grant encourage people to go to college rather than join the workforce? I don't know. I think it's a small thing. There may be some indications of it, but I don't see Pell Grants convincing people to go to college and not join the workforce. There are other things that cause that, more important than Pell Grants. Okay, unemployment benefits, they're extended. As I said, the unemployment level stayed stubbornly high from 2008, 2009, 2010. It finally recovered in 2011, fourth quarter of 2010, and the government continued to extend these unemployment benefits beyond the 13 weeks. All right, minimum wage laws, another problem. Sometimes we have laws enacted at the federal, state, and local levels, including cities like Los Angeles, Seattle, New York, etc., that provide workers and employees with a level of income that they have to pay. I think the federal level now is still $7.25. There are cities and towns now that are talking about raising it to $15 an hour from $7.25. This creates some problems. Mainly, if it's not done correctly, it will increase the number of unemployed. It may also, it has the effect, it can increase the number of unemployed. It can increase the number of part-time workers and decrease the number of full-time workers, and it can also cut back the hours that people work. Okay, if there is an equilibrium rate established in a country, if you go in and you say you want to pay out a minimum wage be above the equilibrium labor rate, that can result in increased unemployment. We've been through this before in another chapter, but it does have the impact if it's not implemented correctly, like phased in over time. Don't go from $7.25 an hour to $15 an hour in the month of January, for instance, and give businesses time to adjust to a lower level labor rate, a higher labor rate, and they can, in time, adjust things and meet the requirements. But if you just slam it on them, it creates big problems for them. And I may have mentioned this, but there are some upscale restaurants in California, for instance, that are putting a surcharge into their bills at a restaurant of 3.8% to cover the hourly minimum wage increases they've had to live with. I can see that working in an upscale restaurant, but I don't know how a McDonald's or a Burger King can do that type of thing, or a Whataburger or whatever. All right, so adjusting the minimum wage has to be done rationally to avoid unemployment. And when I say rationally, it means phase it in over time. Or, don't go in 2017 from $10 an hour to $15 an hour in 2018. That just it creates havoc in the business world and the business community, and also can result in unemployment. Okay, role of labor unions. Labor unions occurred in the time frame probably when they were most needed. We talked about, for instance, during the Industrial Revolution, there were no labor laws. There was quite a bit of child labor, labor abuses, people having to work in sweatshops for 12 hours a day, 6 or 7 days a week. So there was absolutely no control whatsoever, and people who had no scruples took advantage of the fact that didn't exist. Well, those problems led to the rise of labor unions, where people came out and said, this is crazy. We need to organize ourselves and go after this problem as a group called workers, United Auto Workers, Electrical Workers of the U.S., etc. All of these labor unions became groups of employees going to the companies and the businesses and saying, look, you're not paying us a fair wage. We're working too many hours. We have a lot of accidents on the job. A lot of people are injured. So we need to fix this situation. And Mr. Businessman, we represent a labor union, United Auto Workers, and we want this problem to be solved. We'll work with you to do it, but it has to be solved. This was, at one point, this was horrendous for a lot of people. The River Rouge plant for Ford, Henry Ford's River Rouge plant outside of Detroit, Michigan, had a walkway. To get into the plant, you had to cross over the river. And Walter Reuther organized the labor union, United Auto Workers, to try to organize the labor force working in the Henry Ford plant. The favorite tactic at this point in time, like for Henry Ford, was what was called a lockout. In other words, he locked them out of the plant. They cannot come to work, they cannot earn a living, and therefore they would suffer greatly. Well, he got his labor union organized, Reuther did, and decided to go to the plant and work in spite of what Henry Ford had decided. Well, Ford hired Pinkerton Guards, Pinkerton Detective Agency, to guard the plant so that they couldn't get in. The Pinkertons got carried away, and as the workers, the union organizers and the workers started across the bridge, the Pinkerton Guards opened fire and killed and wounded several people. Well, that was probably the highlight of the whole problem. And at that point in time, of course, the government perks its ears up and it knows it has to get involved. So the labor unions, they bargain collectively. This is the key to a labor union. The ability to bargain collectively has to be recognized both by the employers and by the union members. Okay, that means we can sit down at the table and we have to negotiate. You don't lock us out and we don't storm the gates of your factory. We have to negotiate. Okay, so what do they negotiate? They negotiate wages, work hours, health insurance, work rules, environment, retirement. All those things are up for negotiation between a business and its union employee members. Okay? They bargain collectively. This is a process where the unions elect their leaders, negotiating team to sit down with the executives in a company and try to negotiate, hammer out a contract for the next year or 2 years, depending on what the case may be. Up until President Kennedy took over, was elected president, government employees could not bargain collectively. They could have a union, but they couldn't bargain collectively with the government. Kennedy ended all this. He gave the government unions the right to bargain collectively, and as a result, a lot of abuses have occurred. Most recent one I can remember is the Veterans Administration, the poor in the Phoenix branch or the Phoenix Hospital, where the veterans were getting poor service. I couldn't get involved. Couldn't get help. I couldn't get in to see doctors for weeks, months at a time. Yet the management of the hospital was phoning the books, saying that everybody was getting seen and taken care of within 2 weeks. This is a horrible thing. And guess what? Somebody said, let's fire somebody. Well, you can't. We're not allowed to. They did fire the person who was the head of it. I think it's a she. She has now sued the government that they could not fire her. She had a job for life. So it's led to some real problems. Uh, so anyway, we'll hopefully we'll fix those. Okay, causes of unemployment. Increased government regulation. Talked about it already. The minimum wage. Governments can do good things and they can do bad things. Very often they'll do something with the right intention, but they'll fail to recognize potential unintended consequences. We've already talked about that. Government rules, regulations that while they sound good on paper or they sound good today, may result in unintended consequences down the road or in the future. So, as we said, the minimum wage laws, if they're enacted and they're too high, it can force unemployment. Now, also, laws restricting layoffs may make businesses less likely to hire employers in the first place. If you can't lay someone off or fire them for cause, why would you hire them in the first place? So they created the National Labor Relations Board to hear employer-employee problems and to rule on those types of problems. That board has come under a lot of criticism because from a lot of businessmen's point of view, it's ridiculous to even go there because they're going to vote in favor of the employee and against the employer. I think that needs to be looked at by the government. Okay, let's talk about aggregate supply and aggregate demand. Let's talk about aggregate demand first. If we took all the demand curves for every product in the United States, added them all up, we would get what was called an aggregate demand curve for goods and services in this economy or in this country. The other piece of it is the aggregate supply curve. If we added up everything everybody produces, goods and services, and we added those up, then we would have an aggregate supply curve for this country and this economy. Now, when the aggregate supply and the aggregate demand equal, they cross the lines. We have an equilibrium, and therefore the unemployment problem doesn't exist. It's when we get off that level or that proposal or wherever it is, that it does create a problem for the economy and does cause unemployment and can cause inflation. So aggregate demand and aggregate supply just take the total of all goods and services produced in the economy. Aggregate supply, the total of all, the supply is the aggregate supply of goods and services produced in the economy. Aggregate demand is the aggregate of all products that consumers buy. Okay, so technology also can cause a problem. Machines replacing factory workers, typical of the automobile industry, where machine and robots have replaced men who build cars. As I probably mentioned, I toured the Ford factory in River Rouge, and the last station in that plant were robots, and they were testing the quality. They were quality control robots, and with lasers, they were testing the quality of every seam and connection in Ford truck F-150s. Okay, hidden unemployment. This has been a problem recently where workers give up looking for a job and they're no longer counted in the workforce. And it's been a huge problem because people have just said, you know what, I can't find a job. I've been out of work for a year. I've been out of work for a year and a half. I've been out of work for 9 months. I just cannot find a job. So what do they? They drop out of the workforce. They're no longer in the labor force. Now, in a lot of cases, people have looked at that and said, you know, it may be time for me to do something I've always wanted to do, like open a dry cleaner, start a business of my own, do whatever I want to do, work for myself and not have someone tell me what to do every day. So there are some hidden benefits in hidden unemployment, depending on how someone reacts to being unemployed. If you take it as, oh my God, I'm no good, I'm terrible, I can't get a job, I'm unemployed, I'm no good, and you get depressed over it, that's not good. That will lead to further problems. However, if you step back and say, hey, this may be an opportunity for me. If I can't find work, maybe I'll do what I always wanted to do. I'll try to do something else. It all depends on your mental attitude. It all depends on how you face adversity. Okay, unemployment and the stock market. All right, now in the stock market, we have a situation where unemployment has an effect on the stock market. And here is an example. Okay, where were we? I had to put you on pause for a minute. My neighbor next door just got home from the hospital. We keep a separate key for him, and he couldn't get into his house, so I had to go help him. All right, so let's look at some of the things that affect unemployment and how they work. And one of them is, and I think I've showed you this before, comparing the stock market to unemployment and how the stock market may be a leading indicator or unemployment may be a lagging indicator of action or what happens in the stock market. But here you'll see the S&P composite and unemployment, and you'll see that the S&P tends to dip when the unemployment starts to increase, a dip versus increase, dip versus increase. And if you look at the recent figures, you'll see that they pretty much move in the same direction at the same time. When the stock market tends to decline, unemployment increases. And as you see an increase in unemployment, the stock market tends to react to it negatively and starts to decline. So, next. The Great Depression was an interesting thing, a horrible thing for people. We think about all the things we have today, unemployment insurance, food stamps, Social Security, the things that cushion us against things like depressions and recessions. Well, they didn't exist during the Great Depression. So what happened was that as a result of not being able to maintain consumption in the economy, the demand curve you'll see in this chart, 1929, the price level was up P 1929. Quantity demanded was Y 1929. Aggregate demand for the whole economy in 1929 was all the way out on the right. And then the recession hit. You moved down to the middle of the recession years, 1933. The price level declined dramatically, okay? And the supply curve had to decline dramatically along with it. So that we not only experienced a fact that the prices dropped, but also the quantities demanded drop. So as that drop occurred, as we went from a production level of 1929 to 1933, that decline represents people being laid off from work. And the unemployment at that point in time, as I have said, reached a good 20%. And it was more than 20% in the middle of it, 1930. You can see when it first hit. It grew rapidly, and it came down slowly, but what really brought us out of the Great Depression was World War II. People went back to work. They had to produce not consumer goods, but military hardware, airplanes, tanks, ammunition, guns, etc. That brought people back to work and created a situation where it pretty much took care of the unemployment situation during the Great Depression. Now, Al Capone, of course, a lot of you probably know the name. He was mafia in Chicago, controlled one of the families, and engaged in bootlegging, prostitution, drugs, etc. You name it, he did it. Well, what he did was, because there were so many men out of work, he set up soup kitchens because these guys were the only ones that really had the money or were making money. Here's an example of one of his soup kitchens. You can see the men lining up to get food to take back to their families. Again, there was no unemployment insurance, there were no food stamps, there was no way to get money to feed your family. So men had to stand in line to get food for their families. It was a terrible situation. At the time, we wanted to make sure that it never happened again. And as a result, that's why we have Social Security, that's why we have food stamps, that's why we have disability insurance, that's why we have Social Security, etc. All right, chapter 16, moving on, the monetary system. Let's talk about money. Money, money, money. The monetary system in the US is also kind of unique, but we're going to cover some of the unique features. Okay, money is an asset that people use to buy goods and services in the economy. So remember, money is an asset. The more money you have, the more assets you have. You use that money to buy goods and services in the economy, to accumulate wealth, to buy fancy things, Fords, Mercedes, Maseratis, whatever the case may be. Money is used for all of those purposes. Now, fiat money, there's two kinds of money. I call one real and one phony. But anyway, fiat money is money with no intrinsic value. That's your US dollar. It's just a piece of paper. It's not worth the paper it's written on. But what makes it of value is that it is supported by the full faith and credit of the United States. And also, it's accepted as payment for goods and services in the economy, even though it has no intrinsic value. There's no silver, no gold, no platinum, none of that stuff in it. It's just a piece of paper with printing on it. Then there's commodity money. This stuff has intrinsic value. This is gold and silver coins, for instance. So commodity money has an intrinsic value, fiat money does not. And that's the difference between the two. You don't see too much gold and silver in circulation anymore. It's pretty much all been replaced. It's a collector's item for a lot of people. A lot of people view gold as a hedge against inflation, turmoil in the economy, turmoil in the world. In addition, using it for gold and silver, both used in the production of components for technological equipment. Contacts are sometimes made of gold. Silver is used because they both have the ability to conduct electricity and electrical impulses very smoothly and very quickly. Okay, functions of money. What are the functions of money? Number one is liquidity. It's a medium of exchange and accepted everywhere. In other words, you don't have to trade a cow for a horse or a cow for a sheep. We don't have to barter. We have liquidity. We have liquid assets called money. And again, it's fiat money. And it's used anywhere in the economy. It's used in all states. It's accepted everywhere as a medium of exchange. So it enables us to buy goods and services, and it's accepted by everyone as payments. Okay? So I pay for the goods and services I want. I use fiat money to pay for those goods and services. Today, we primarily use our debit cards or credit cards. The unit of account. Okay. We use the concept of money, the dollar, to measure everything we do financially. Financial statements for businesses, firms, the government, etc., are all translated into dollars and cents. The stock markets, all traded, all reported in dollars and cents. So it's a measurement of all things financial. And the key in a lot of places is to be able to put a financial measurement or target or value on something so that you can understand what it's really worth. One of the problems that we have in economics is the trade-off between, for instance, we talked about what is the cost of pollution control. How do we measure those things? What are we know the social benefits. What are the financial benefits, if there are any? Next, it's a store of value. Okay, so it does have value. We have to be careful. The dollar bill is a dollar bill. It's printed with a dollar on it, and it always is a dollar. But if we look at money in terms of purchasing power, we have to adjust for inflation. And the example here, we've used it before, consumer price index goes up 2% year over year. The dollar we put on our mattress is now only worth 98 cents in purchasing power. So while the currency itself still says a dollar on it, okay, the value of it may have increased or decreased, whether we're talking about inflation or deflation. Okay, so over time, even though it's still a dollar, it may not purchase as much as it used to, or as it did in this example, a year later. All right, now the money supply in the U.S. is composed of two components. One is named N1, the other one is M2. So the money supply in the U.S. is M1 and M2. So let's look at those two pieces. M1 is part of the broader measure of M2. So you guys should understand, M2 is the whole Megillah. The whole thing, the whole pie is M2. M1 is only a part of it. So M1, what does it consist of? Currency in circulation and all checking accounts. Now remember, a checking account is also called a demand deposit, right? Because again, it's your money, you put it in the bank, you can take the money out anytime you want. For you, that money is an asset in the bank. For the bank, it's a liability because they owe it to you. So M1 is currency in circulation and all checking accounts. M2, therefore, also includes savings deposits, money market deposits, and a few other things. Money market mutual funds, which are the dollar mutual funds, and small denominated time deposits. A small denominated time deposit might be something like, instead of a savings account that pays 0.2% interest, you may say, Uncle Harry gave you $5,000 to go to college. You're not going to need it, let's say, for 6 months or so. So you put it in a small denominated time deposit, and they pay you a little bit higher rate of interest than the 0.2% you might be getting in a savings account. So again, M1 is the smaller piece, M2 is the whole Megillah. So M2 includes savings accounts, checking accounts, money in circulation, market money deposits, money market mutual funds, and self-denominated time deposits. Acceptability of money. The US dollar used to be backed by gold, and it was called the gold standard. And this was prior to World War II. The gold that we have in the United States is stored in Fort Knox, Kentucky. It's a vault in the middle of the golf course. It's very difficult to get into, if not impossible. I'm not sure anyone really knows what's really stored in there or how much it's worth. It's something we don't, for some reason, talk about in terms of the government. But anyway, the US dollar was at one point in time backed by gold. And gold was set at $35 an ounce. So what that meant was the gold backed the dollar, and the gold was worth $35 an ounce. So it took $35 to buy 1 ounce of gold. A little bit different than today. Gold is almost $1,300 an ounce. So after the Second World War, the industrialized countries of the world adopted the gold standard as part of what they call the Bretton Woods Agreement. I think Bretton Woods is in Maine, or New Hampshire, someplace like that. Anyway, a place with a lot of big mosquitoes. So these guys got together and decided we've got to set a standard so that we can, the idea behind it was everybody was using the same standard, and therefore it was the basis for engaging in international trade, okay? Which kind of made sense, because then if you tied the dollar to gold and tied everything else to the dollar, you could then figure out what you are actually trading for and what you're actually paying. However, currencies tend to fluctuate regardless of whether they're based on the gold standard or not. So it put countries in a position of not being able to adjust their exchange rates relative to any kind of inflation that might have been occurring in their country. For instance, if you have inflation in a country, in a small country, and you're selling goods overseas, that inflation rate is going to drive up the cost of your goods and services. Now, the way to protect it in terms of purchases from overseas accounts is to reduce your exchange rate so that you take away that inflation effect on the goods and services you're exporting, okay? But since their currencies were all tied to the gold standard, it didn't work. They couldn't do the adjusting that they needed to do. So what they did was they decided we can't use the gold as the gold standard or the standard for international trade. We have to use currencies. It used to be the British pound, but after World War II, it became the US dollar. Now, in President Nixon's administration, the US abandoned the gold standard as well. The interesting thing at that point in time is Americans could not hold gold or silver, I think. And as a result of Nixon taking us off the gold standard, we could. And of course, as we know, the price of gold just went crazy. It went to $3.50 an ounce to $8.50 an ounce, up to, I think it got as high as $1,800 an ounce. It's now back down to about $12,000-$13,000 an ounce. $1,300 an ounce. Okay, so went off the gold standard. We said, all right, guys, the basis of the dollar is the full faith and credit of the United States. We are going to support our dollar regardless of the gold issue, or going off the gold standard. So now let's talk about how all this money is controlled in the economy, or adjusted, or increased or decreased. And that answer comes in what we call the Federal Reserve System in the United States. So the Federal Reserve was created in 1913 by the Federal Reserve Act in response to a financial panic in 1907. In 1907, people panicked. There were all kinds of, any bank could issue money, create money, print money. There was a severe panic in 1907, and there was a rush on the banks. The banks were forced to try to pay out all their depositors. The problem was they didn't have the money to pay them out. So as a result of that panic, the banks were closed, called a bank holiday, because they couldn't pay back the money that they had on deposit. So in order to prevent that from happening again, in 1913, we created the Federal Reserve Act, which created the central bank. It was chartered by Congress for three main objectives of monetary policy: maximum employment, stable prices, and moderate short-term interest rates. So that was their goal and their basis for doing this. Now, over the years, we've changed it somewhat. They now conduct the nation's monetary policy. They're tasked with maintaining stability of the financial system, which they did do during the Great Recession, providing financial services to depository institutions. What that means is that, particularly in the case of member banks and non-member banks, they use the Federal Reserve as a depository institution. Now, how do they do that? In the clearing and collection of checks, the amount of checks that are deposited in a bank during the day are then sent to a Federal Reserve Bank for processing. The bank checks are then circulated through the Federal Reserve System. If they're in one district, they go to another district and they end up in the bank of the depository or receiving entity. Okay? So they are the clearing and collection of checks agency within our country. In addition to that, they task them with providing some research on different things, essentially things that are occurring in the economy, to see if there isn't a better way to do things, or what went wrong, or etc., what can be done better. Okay, oversight of the banks and Wall Street financial institutions after the 2008 financial crisis. In the 2008 financial crisis, what happened was a question of liquidity. The people who bought these investments, credit default swaps, were told that these investments were insured. They were insured by the financial institution they got them from. But when everything started to collapse and people started to panic and they went back to their financial institution and said, we want our money back, they had a tremendous liquidity problem, because, as with all insurance, only a portion of the risk is kept in assets, namely cash. So the banks couldn't possibly be able to handle out or hand out all the money needed to make these investors whole. So as a result, the financial crisis brought together not only banks, but also investment banks. Since the investment banks, JP Morgan, Merrill Lynch, all people like that, needed money, currency, to meet these obligations that people were drawing on them, the Federal Reserve opened their loaning window, or discount window they call it, and these banks, as long as they became bank holding companies, were now able to borrow money from the Federal Reserve. And as a result of that movement, what happened then is that where the commercial banks were regulated by the Federal Reserve and the investment banks were regulated by the Securities Exchange Commission, all the banks came under the regulations of the Federal Reserve. So part of the problem that helped cause the financial crisis has been solved, in that we now have one organization that can look at all the books, both the trading books and also the depository books from clients, and make sure that these financial institutions are sound. Couldn't do it before 2008, 2009. Okay, let's look at their structure. It's composed of 7 board members. A chairman and vice chairman are appointed by the president and confirmed by the Senate. So one of the things that's going to become clearer to you is that the Federal Reserve is not a government entity. It's separate from the government. The only involvement the government has with it is that the President of the United States appoints the chairman and the vice chairman, and they're confirmed by the Senate. The biggest piece of the Federal Reserve is the Federal Open Market Committee, often referred to as the FOMC. The Federal Open Market Committee meets, I believe, about 8 times a year. And what they do is they set policy for the Federal Reserve for the coming quarter. So decisions that are made by the Federal Reserve come out of the Federal Open Market Committee. They are the ones that make the decisions. It's also composed of 12 regional banks, Federal Reserve banks. There's one in Dallas, downtown in Dallas. You can go down there and take a look at it. There's also in Dallas a Bureau of the Mint where they print money. Okay. Privately owned member banks and various advisory councils are members of the Federal Reserve. You could be a member bank in the Federal Reserve, but you don't have to be. So the FOMC sets monetary policy, consists of all 7 board members and the 12 regional bank presidents, only though 5 vote at any one point in time. So when FOMC meets, the 7 board of governors are part of it. The 12 regional bank presidents are part of it, but only 5 of the regional bank presidents get to vote on policy set down by the Federal Open Market Committee in any meeting. Federal Reserve districts. Here's what the map of the U.S. looks like. And you can see district number 1 is Boston. And then you have New York, Philadelphia, the Board of Governors in Washington, D.C., Richmond branch, number 5, Cleveland, number 4, Chicago, 7, 6, etc. You look at us in Dallas, we're District 11. San Francisco is the largest geographical district. It's comprised of most of the western states, and as well as Hawaii and Alaska. So geographically, the San Francisco district is the largest. Dollar-wise, the New York district is the biggest. Actually, the biggest district from the standpoint of dollars and volume that goes through it. So we have a district here. Now, as we said earlier in the course, the first 2 digits of your check on your checking account, if you're in a commercial bank, are the Federal Reserve district that your bank is located in. And anything coming out of this area would be 11. So that's the way it lays out. Each of these banks have a president. The management. This is what it looks like. So the Board of Governors is at the top of the pyramid, but the decisions that are made come from the Federal Open Market Committee. The Board of Governors are members of that committee, but the decisions on what we're going to do with interest rates, reserves, etc., any rules, regulations regarding the banking system all come from the Federal Open Market Committee. So then the next piece of the pyramid, we have the Federal Reserve banks, you have member banks, you have other depository institutions, and on the bottom of the pyramid, you have the American people. It's a unique system. One of the things that makes it unique is that it's not part of the government. The Federal Reserve does not report to the Secretary of the Treasury. It's not part of the Treasury function. Whereas if you look at most of the other countries in the world, the central bank, which is what the Federal Reserve System is in the US, the central bank is part of the government and it prints the money. The Federal Reserve does not print money. The Federal Reserve strictly is a regulatory agency. The Treasury Department prints the money. Even though it says Federal Reserve note, it's not printed by the Federal Reserve. Okay, so the reason it is unique is it has both a private and public component. In other words, it's composed privately of its members, which are non-governmental, and also it has a public function in that it has to manage the interest rate and the functioning, the financial functioning of the economy. So it's got a public and private component. So it's designed to serve the interests of both the general public and private bankers. Okay. The structure is unique among central banks. Why is it unique? As I said, it's not part of the federal government. It's separate from the federal government. It's not like China, where the People's Bank of China runs everything and prints the money. It's not like the Bank of England, which is under the Chancellor of the Exchequer, and it also runs the financial system and prints the money. So it's an unusual entity in that it doesn't create the currency. It's outside a central bank. The currency is a treasury function. So that's part of the thing that makes it unique. These things make it totally different from a lot of other countries. For instance, the Communist Politburo in China tells the People's Bank of China what to do. That's not the case in the US. As a matter of fact, the Federal Reserve System does not report to the Treasury, as I said, but it is responsible to the Congress. The Congress is the one that controls the purse strings in the US. So what happens is the chairman of the Federal Reserve, in this case today it's Janet Yellen, she goes to Congress before the Banking Committee and submits her latest report on the goings on of the Federal Reserve and what they see going to happen in the economy. They do not report to any government entity, any government department, other than they are responsible to the Congress of the United States. All right, government oversight. Okay, it's independent. Monetary decisions don't have to be approved by the President of the United States. In other words, the Federal Reserve makes decisions and institutes policy and impacts interest rates, the branch banks, etc., without the approval of the President or anybody else. So where does it get the power to do this? It gets the power by statute, and those statutes were enacted by the Congress. So therefore, the system, Federal Reserve, is subject to oversight by Congress. Now, some control is exercised by the government in that it sets the compensation for the higher level of executives. That's really the only influence they can have. Okay? Membership in the Federal Reserve. Member banks, private institution, they own stock in the Federal Reserve, particularly in the regional banks. State charter banks can become members, but they have to meet standards set down by the Federal Reserve. Mainly standards that relate to their balance sheets. How strong are they financially? Okay, 38% of the US banks are members approximately, so you don't have to be a member, but everybody has to abide by the rules of the Federal Reserve. So when you own stock in the Federal Reserve, it's not like owning stock in a company. It is not a certificate of ownership. The only thing it does is it gives you a dividend, in effect. And it has to be, you have to buy stock in the Federal Reserve up to 3% of your capital reserves. So it's not like stock in a public company. It can't be sold or traded, and the members do not control the Federal Reserve as a result of owning stock. In other words, the members of the Federal Reserve, who are private banks around the country, do not have a say-so in what the Federal Reserve does. The Federal Reserve's Federal Open Market Committee makes all the decisions, and these stock owners, are not part of that decision-making process. So they do elect 9 board members of their regional bank. For instance, member banks in Texas or in the district called Levin, headquartered in Dallas, do elect 9 members of the board of the regional bank headquartered in Dallas, Texas. Now, why would they do that? Why would they pay a member to do that? Maybe they wanted to have a say-so in what goes on in their own territory. Ownership. It's symbolic. They don't exercise any control over the Federal Reserve other than they collect a dividend. So it's totally separate from the members. It's totally separate from the federal government. It's not a department of the administration or of any other group. It is responsible to the Congress of the United States. Okay? Earnings, they make money. Fed engages in operations that generate fees and income. How do they make income? Well, they clear and collect checks. In other words, if you write a check and you send it to a bank, it's going to go through, let's assume that it's a payment to somebody in California. It will go through the Federal Reserve District in Dallas, and then it'll go to San Francisco, and then it'll end up in the bank that you wrote It'll go to the person you wrote the check on, and he will deposit in his bank in that area. They also do electronic funds transfer, which means that if you need money transferred to an account from one state to another, it will be done through the Federal Reserve System. I give you a perfect example of that. When we closed our house here in Texas from California, we were in the office of the, what do they call it, title company. And this was the last working day of December in 2013. And unfortunately, the people who were doing the loan for us miscalculated what the closing costs would be by about $3,000. So instead of being $6,000 in closing costs, they were $9,000. So right there from the office in the what do they call them, title company, we made a phone call to our credit union in California, told them we needed $2,000 transferred to such and such a bank here in Texas. That transaction was accomplished within 1/2 of an hour. So we had the funds transferred, and of course, the Federal Reserve exacted a fee for doing that. Okay, they also have deposit accounts. Member banks deposit money in them in which they earn interest. And they also lend to member banks. Okay? We talked about the Great Recession. JP Morgan, for instance, becoming a bank holding company, and they were in a position, therefore, to borrow money from the Federal Reserve to cover their liquidity problems during the financial crisis. All right, the income that's turned over. They make quite a bit of money. In 2009, they turned over $47 billion. Okay? And they paid $1.4 billion of it to member banks in the form of dividends. 2010, $79 billion, and 2011, $77 billion. So while they are not controlled by any department, particularly Treasury in the government, they turn over their money to the Treasury. And the Treasury, of course, in terms of money and financial transactions, is responsible to the Congress. Interestingly enough, the Congress is the cashier for the federal government. They manage all the funds, the budgeting, etc. Falls in the realm of the Congress. Now, money multiplier is an interesting thing, and it works a lot like insurance. You have $1,000, $100, whatever the case may be, and you take it and you deposit it in your bank and you put it in a checking account. The bank takes your $1,000, $100, whatever, puts it in your account in your name, so it's owed to you. So to you, it's an asset. To the bank, it's a liability because you can come in and take that money anytime you want, assuming it goes into a checking account. Now, what happens then is the bank, in turn, has to reserve, based on federal rules, 20% of the money. So the bank puts on deposit in its own account, in its own bank, 20% of the $100 or $1,000 you gave them. They can then turn around and lend out to another party through a loan, consumer loan, any kind of loan, industrial loan. They can lend out, okay, 80% of what you put in. And that is what we expect banks to do. Now, what that is called is a money multiplier. So $1,000, well, let's look at it. Here's what happens. You deposit $100 in your bank. They lend out 80, they keep 20. Then they lend that out to somebody else. Bank B gets the $80 as a deposit. They reserve 20%, but they can lend out $64. It goes to Bank C. It's lent out to another customer. That Bank C has to reserve 20%, etc. on down the line. So what we mean by the money multiplier is if you added all this up, that $100 became $400. Okay? So 4 times return. So that's how banks create money. So here's where the banking system comes in and the Federal Reserve comes in. If they raise that reserve, the member banks, commercial banks, can lend out less. If they lower that reserve, they can lend out more. Let's assume they only have to save 15%. Then they can lend out more money. That's one of the ways that the Federal Reserve controls the money supply. If the economy is too hot and we've got inflation, they will raise the reserve requirement to cool down the economy and pull money out. Okay. If we've got unemployment and we need to stimulate the economy, they can lower that reserve, put more money into circulation, and allow commercial banks, member banks, to lend out more money. Okay. That's how the Federal Reserve operates within the economy to help control inflation and reduce unemployment. Important concept. Make sure you understand the role of the Federal Reserve. They have lots of tools, and we're going to go through the tools, the other tools that they use. Member reserves are one of them. Okay, monetary policy. One of the other ways they do it is by buying and selling securities, particularly government securities, treasury bills, T-bills, 10-year notes, 20-year notes, 2-year notes, etc. Okay, so if the Federal Reserve is in the mode to expand the economy, they will buy bonds, and by buying bonds, they're putting cash out into the economy. Again, buy the bond, cash goes out into the economy. If they sell the bond, they're making somebody pay them the money, and they're taking money out of the economy. So buying and selling securities is a tool that they use of monetary policy to control inflation, unemployment. They also can raise or lower the reserve rate, which we talked about a minute ago. If they want to decrease the money supply, slow things down, they raise that requirement. If they want to speed things up, maybe they got unemployment, they can lower that requirement. Discount rate. Another way they can control it is the banks borrow from the Federal Reserve on a daily basis. Okay, they're in and out of the Federal Reserve every single day. I worked for a bank in Idaho. We used to package up the checks every day. The Federal Reserve would come and collect them by armored car, and they would go into the banking system. They would pay us interest overnight on what we deposited in the Fed. Okay, so these interest rates are being paid out every day. The interesting thing is if they pay an interest rate, and they also can charge an interest rate on your borrowings. So one way they can do it is they pay an interest rate. If they're paying a high rate, that's a good thing. That stimulates the lending of banks. If they reduce that rate or they charge an interest rate, a higher interest rate on borrowings from the Federal Reserve, they do the opposite. It makes it more expensive to borrow from the Federal Reserve, and therefore it's more expensive to lend money out because they've got to cover their own costs of borrowing. Interesting concepts. The Fed funds rate is the rate that they charge one another for overnight loans. Okay. And the prime rate. Now, a lot of people confuse the Fed funds rate and the prime rate. So let's try to make sure you understand the difference between the two. The Fed funds rate is the interest rate that the Fed charges. And it's also the rate that banks charge one another for overnight loans. So this means that the Federal Reserve rate, the Fed funds rate, is kind of determining what's going on in the economy. So what banks do is they use that Fed funds rate as a criteria. They use it as a criteria for setting what they call the prime rate. Now, the prime rate is a benchmark rate that all banks use to determine what their interest rates are going to be, what interest rate they're going to charge on loans to depositors. Okay, so the spread between the Fed funds rate and the prime rate is always about 3%. The reason that is that banks rationalize that the cost of their operations are going to be a minimum of 3% between what they can borrow from the Federal Reserve and what they can charge customers. So the prime rate is the rate that a commercial bank will charge you if you're a Donald Trump or Steve Jobs, not Steve, but Malcolm Forbes, people like that high-end people, millions and billions of dollars, okay, can borrow at the prime rate. Vince Neubel, Hank will probably say, look, Vince, you're a great guy. We're going to charge you prime rate plus 2%. So if the prime rate is, let's say, 1%, let's say the prime rate is 4%, Vince can borrow at 6%. So the banking system uses the Fed funds rate to determine what rate they're going to charge their commercial customers. Okay? Again, let me say that again. The Fed funds rate is the rate that the banks use to determine what rate they're going to charge their customers on their own lending. And that rate is generally 3% higher than the Fed funds rate. Remind me in class, I'll show you a chart that shows those relationships over time. Okay, the Federal Reserve tasks. Federal Reserve is tasked with managing, controlling inflation. They'd like to see about 2% a year. Currently, it's been going a little bit less than 2%, but that's a criteria they have. They don't want it to be lower than that. They don't want it to be higher than that. They really don't want it to go above 3%. Right? So they bracket it. They want the Federal Reserve, they want the inflation rate to be somewhere between 2 and 3%. Now, while we talk about the Consumer Price Index as a measure of inflation for us, the Federal Reserve uses a different criteria. They call it the personal consumption expenditures. And it includes more things than those that are in the CPI. Remember, the Consumer Price Index is a basket of goods. In other words, it's a composite of things we buy, households, real estate, cars, TV sets, etc. But they want to use something with more information in it than the CPI. So they've come up with what's called the Personal Consumption Index, or PCE. So the CPI captures urban consumers' spend on a basket of goods and services, as I mentioned. The PCA, though, captures all goods and services in that, plus, all right, employers and federal programs for consumers, plus it also includes co-pays when you go to the doctor, Medicare expenses, things of that nature as well. So what they've done is they brought into the whole concept federal programs for consumers, and they also brought in the cost of medicine, the medical costs, particularly in the form of co-pays, or that portion of it that the employer pays, or you pay when you go to the doctor. So when you go to the doctor and pay $25 for your copay fee to go see the doctor, the Federal Reserve includes that in their PCE, and that's what they're looking at as inflation. If, for instance, those copays go up from $25 to $35, that would be reflected in the numbers that the Federal Reserve is looking at. Okay, so the Federal Reserve. Monetary policy is carried out by the Fed. The Fed uses the tools we just went through to increase or decrease the money supply. They want to increase the money supply if we're in a situation of unemployment and we want growth. They decrease the money supply if we've got too much growth and the resulting inflation. They want to decrease the money supply. That's what they go after. So in increasing the money supply, the Fed is giving us a signal, or giving the markets a signal, that it's looking to expand and grow the economy. Decreasing the money supply, they're giving us a signal that they want to control inflation. Inflation is too high and they want to reduce it. So what investors, analysts in the stock market and the federal government continually are looking at is what are the actions of the Federal Reserve, and what Congress is looking at are the actions of the Federal Reserve consistent with their objectives. In other words, in times of recession, are they liberal in their interest rates and reserve requirements? In times of high inflation, are they restrictive in the reserve requirements and interest rates? And that's why they have to go and report, usually on a monthly basis, to the Congress. Tools, the Federal Open Market Committee is the policy arm of the Federal Reserve, which we mentioned. It meets 8 times a year. sometimes more frequently if it's needed. And during the financial crisis, of course, they met monthly. All decisions are made by the Federal Open Market Committee. All decisions regarding monetary policy come out of that committee. It's chaired by the chairman. In this case, currently it's Janet Yellen. So it's chaired by Janet Yellen, appointed by the president. You'll notice that committee, there's no one in the administration that's in there. There's no one from the Congress that's in there. It's strictly members of the Federal Reserve System around the country and in Washington, D.C. So the government is not even involved in any way, shape, or form in the policy making decisions of the Federal Open Market Committee, which is the policy arm of the Federal Reserve. So nobody is there from the administration, and no one's there from Congress, and no one's there from the state or local governments. Okay, we talked about this. They can buy bonds. If they want the money supply and stimulate the economy, they buy bonds. Why? Because that puts money out into the economy. During the Great Recession, they had a program called QE, or quantitative easing. And what that was is they were buying as much as $85 billion per month in federal treasury bonds. The idea behind it was to keep interest rates low, particularly mortgage interest rates, so that people would be encouraged to get back into the housing market and buy a home. Okay? So the purpose was to stimulate the economy, hold interest rates down. The QE program, quantitative easing, and they had three of them. They had QE1, QE2, and QE3. The last one, QE3, I believe, ended in February of 2015. Okay, it's a wonderful program, but the problem is it's gotten a lot of criticism. Government deficits are huge, and a lot of people say that the only reason the government was able to continue to spend more money than they took in was because the Federal Reserve was buying all their bonds. Okay? In addition to that, when you are stimulating the economy, there are two kinds of people out there, the people that are hurt and the people that are doing well. Now, in a situation where you're reducing interest rates, the people that can afford to borrow are the ones that can benefit the most. And a lot of the criticism of this program is that all it did was finance the growth of Wall Street and the Dow Jones Industrial Average. Okay? Time will tell. So the Fed now, well, it's not 2 trillion, now it's 4 trillion. And 3 trillion of that is government bonds on their balance sheet. Now, at some point in time, the Federal Reserve, where they bought that and put money into the economy, they're going to have to sell that stuff to take money out of the economy. And the big concern is that when they begin to do that, will have a dampening effect on the economy and cause us to fall into another recession. Maybe not as bad as a recession, but dampen the growth of the economy because they've got to get rid of all this debt that's on their balance sheet, all these bonds. Okay, selling bonds. Fed can also sell them. I'm going to go through this pretty quickly because we've spent a lot of time on it. Selling bonds reduce the money supply and raising interest rates because they're taking money out of the system. And as we said, they're going to start to sell off this $4 trillion. They've already talked about starting that this year. This probably will become reality. We'll have to see what happens to it. So the impact of this, however, and the reason people are concerned is it will reduce the money supply, it'll slow growth and inflation, and eventually interest rates will rise along with it. So it's a big concern, and it's going to be watched. The Federal Reserve has to get rid of this debt. It's too much, it's too high. These bonds are maturing, and as they mature, they are not going to renew them. Some of the bonds are 2-year bonds. Okay, interest rates, we've already talked about that. I want to show you a chart that shows the difference between the Fed funds rate and the prime rate. But raising and lowering those interest rates, if they want to stimulate the economy, they lower the interest rate. If they want to destimulate the economy, fight inflation, they raise the interest rate. Commercial banks create money through their deposit and lending functions. I showed you that in that chart, money creation. They base their lending rates on the discount rate that the Fed charges, actually the Fed funds rate. The lending rate they use, the prime rate, is generally 3% above the discount rate. We went through that. As the prime rate, commercial bank will generally lend at above the prime rate depending on the creditworthiness of the borrower. Again, Donald Trump is at prime rate, Vince Neubel is prime plus 2%. So we use the term Fed funds rate and the discount rate in the same vein, but basically it's the prime rate which determines the 3% above the discount rate. Loan rate would be 2% over prime. That's you, Vince. Member reserves, we talked about this one. Raise the reserves to reduce lending. Increase the reserves to slow down their lending. Decrease the reserve to encourage lending and money supply. Banks, a member, not a state bank, all banks. Now, here's the thing. We talked about 38% of the commercial banks in the U.S. being members of the Federal Reserve. Well, you don't have to be a member of the Federal Reserve. Okay, that's why it's only 38%. Now, but what that means is that even though you are not a member of the Federal Reserve, you have to follow Federal Reserve guidelines and rules, even though you're not a member, because they are the central bank of the country, the United States, and they are responsible for managing these banks, managing how they operate. With the Federal Reserve, the Federal Deposit Insurance Company does audit of the Federal Deposit Insurance Commission does audit of these banks, audits their financial statements to see how they're doing. So that's all part of the process. Oh, excuse me. Okay, that ends it for now. Once again, remember there is no class on Tuesday. These two chapters are for your quiz when we get back after the first of the year, and I believe that's the 22nd. I mean, excuse me, not after the first of the year, but after the Thanksgiving holiday. So have a great vacation, a great Thanksgiving, and I'll see you all back on the 22nd.